Hi, I'm Greg Hunter with USAWatchdog.com. With us, a guy that runs Euro Pacific Capital, also has Schiff Gold. That's a spoiler alert for Peter Schiff. Peter Schiff, thank you for joining us today on USAWatchdog.com.
Hey, my pleasure to be here.
You couldn't be on at a better time. Brexit, what's the real story about Brexit? Is it because they voted to get out, or is it because that the whole system is putrid and full of debt?
Well, it's more the latter. You know, if the global financial system, if the markets were healthy, Brexit would be a non-event. I mean, what difference does it really make in the scheme of things whether the UK is part of the EU? I mean, it really doesn't make too much of a difference. And a healthy economy, it would just shrug it off. But because we have anything but a healthy financial system, it's all a gigantic bubble. It's a house of cards, and that's how fragile it is. And it's all propped up with cheap money and negative interest rates and quantitative easing. And everybody is confident that the central bankers and the politicians could keep all these bubbles in the air that they're juggling. And now all of a sudden something goes wrong that they didn't expect. It shows that the government is losing control. And this is the wake-up call. This is what has got somebody so scared. This is the match that ignites the powder keg. But the powder keg was there all along. It's just that nobody wanted to acknowledge its existence until somebody applied the match.
I think the last time you were on, you were saying that, listen, they're not going to raise rates. Well, you were right. And then you also said that, by the time we're done, I'm paraphrasing roughly, you said that they're going to end up with QE4. Do you think this is the match that also lights, Yellen and the Fed to turn the afterburners on with the money printing?
No, it's maybe the excuse. See, they were going to do it anyway. Now officially, if you look at the markets are now pricing in a higher probability of a rate cut than a rate hike. But I said that back in December when the Fed first raised rates. I said, well, the next move is likely going to be to reduce them, not a second hike. And at that time, everybody thought, well, the Fed is going to raise rates 3 or 4 times in 2016. And I said, no, they're more likely to cut rates back to zero than to raise them again. Now the markets are coming around to my way of thinking, but it took Brexit to get them there. But what I said back then is that it didn't matter how we got there. We were going there because the Fed was just looking for an excuse to save face. Because the real reason that the Fed is going to cut rates is because this bubble economy can't survive with even the smallest of rate hikes. So it's the fundamental problems in the U.S. economy that are worrying the Fed. But it doesn't want to admit that. It doesn't want to undercut its own credibility because it's been pretending it saved us. It doesn't want to undercut Barack Obama and Hillary Clinton because they're pretending that we have this legitimate recovery. So now they've got a face-saving excuse to do what they were going to do anyway, which is launch QE4 and cut rates, because now they can say, look, there's nothing wrong with our economy. It's because of the problems in the global economy. And since we're not an island of, in and of ourselves, we have to respond to what's going on around us. The Fed is going to use that to rationalize why they should, do more QE and not admit that QE didn't work, but pretend that it did as justification for doing it again.
And what happens to gold and silver? Have we just seen the opening act, this vault up in gold and silver? I know there's going to be bumpy along the way, but what happens to gold and silver when basically, they're overtly printing money and helicopter dropping it from the sky?
Yeah, this is a lot more bullish for gold and silver than is generally perceived. And one of the reasons I think that gold and silver haven't been even stronger is because of the relative strength. I'm saying relative strength of the dollar, because a lot of people have been unwinding their risk-on trades, their carry trades, by buying dollars and buying yen. And so this has caused a lot of currencies to drop. So the big moves in gold are happening not in the dollar, but in other currencies. Look at the pound sterling. You saw a 20% jump in the price of gold in 2 days. That could be unprecedented in the UK. That is a huge loss of purchasing power of the pound in gold terms. But I think you're going to start to see these kind of losses, maybe not that dramatic in one day, but you're going to see that happening across the board in all these fiat currencies, because once the carry traders are finished unwinding their bad bets and the fundamentals reemerge themselves, what is happening right now is not bullish for the dollar, right? If this is what enables the Fed to admit that it's going to cut rates, that it's not going to raise them, that it's doing QE4, this is very negative for the dollar. So once the dust settles, the dollar's going down. And in the meantime, people can use this window of opportunity to position their portfolios. If you're still in the dollar, this is your last chance to get out. And I would recommend people that are, listening to, your YouTube channel, contact me at my, Europac.com, EUROPAC.com, and let me manage a portfolio for you of non-dollar assets. Take advantage of this dead cat bounce in the dollar to get money into Switzerland and New Zealand and Singapore or Norway or Hong Kong or any of the real safe havens. And don't be afraid to buy gold. Don't think you've missed something. It's just beginning. I mean, yeah, gold's up quite a bit. What is it? $80, $100, since the Brexit. But it's only 13, 15 or something like that. I mean, gold got as high as 1900 a few years ago. And believe me, the global economy is much more screwed up now than it was back then. And we certainly printed a lot of money, a lot of dollars, a lot of euros, a lot of yen since then. And we're going to print a whole lot more in the days ahead, because this is going to be a huge crisis. Look at, Alan Greenspan was on CNBC saying this is the worst thing he's seen in his career. He's not talking about what's already happened. He's talking about what's about to happen, because he ought to know how screwed up this economy is, because he helped screw it up. And he understands how his policies failed, and more importantly, how the Bernanke and Yellen's policies have failed on an even grander scale.
Well, do you think that that gold is just a beginning act then, and you think it's going to go much higher? And I'm not trying to give you to get you, but you think it's going to overcome its previous all-time highs?
Oh yeah, I mean, and we saw gold intraday on Friday up better than $100 an ounce, and it didn't hold those gains, but it spiked up there briefly. But look, one of these days you're going to see gold moving up at $100 clips routinely. When people really perceive the dangers in the fiat world, and people really come to grips with just how much money these central banks are going to print, because none of them really have the integrity to honestly default. So they're going to take the coward's way out and print. And it's a long way down. The intrinsic value of fiat currency is zero. And some of these currencies are going to end up trading their intrinsic value. So you're going to see a huge move globally into gold and out of fiat, and that hasn't even begun yet. I mean, wait till the stampede. So that's why I'm saying, you want to get positioned before that. Gold stocks, look, we've got gold stocks that are up. I manage a gold fund. It's up better than 100% this year. I think maybe 104, 105%, something like that. It's not even 6 months into the year. Of course, individually, you can find individual gold stocks that have tripled or more during the year. But even to have a diversified portfolio more than double in less than 6 months, but these stocks are still cheap. So it's not too late to get in. And also physical gold, as I said, if you don't have any physical gold, I've been recommending everybody should have 5 to 10% of their portfolio in actual gold that you own, gold and silver. If you don't have any, you can get some from me. My gold company is SchiffGold.com. We've got the best prices online, and you can talk to an actual human being to help work with your order. So, if you don't have your gold or your silver, if silver's probably got even more upside, don't wait, buy today, because I think the prices are going a lot higher.
And what about the manipulation from Deutsche Bank? I mean, they admitted they settled a case that they admitted to manipulating the gold and silver market. They're a primary dealer of treasuries. They also put the finger on HSBC. They didn't admit to it, but Deutsche Bank put the finger on HSBC and also Bank of Nova Scotia as their helpers on at least this side of the pond, at least that. I mean, your advice back in 2011 and 12 was to buy gold because the debt was exploding, and now we find out it was good advice. They just manipulated it to make it look terrible. What are your views on this massive exposed manipulation admitted by Deutsche Bank?
Look, the manipulation is not going to work. I mean, ultimately, the forces of the free market will overwhelm any potential manipulation. And I think a lot of it is not a devious type of manipulation. It just reflects the views and the opinions of the traders who just don't know what they're doing. And, obviously, from a timing perspective, if you waited until 2011, 2012 to buy all your gold, you didn't do a very good job. I mean, I was telling people to buy gold since 1998, 1999. And I've been advising people to just average in and continue to add to your holdings, as you become wealthier, right? If you're going to keep 5 to 10% of your portfolio in gold, assuming your portfolio is rising, which it should have been doing, then you should be adding to your gold holdings. And the fact that gold went down from 2012 to 2015 was a good thing if you were trying to add to your gold holdings, because it lets you buy more gold at a lower price. But a lot of people like to point to the fact that, well, if you bought all your gold 3 or 4 years ago, look how much you're down. Yeah, who was dumb enough to do that? Some of the people that were dumb enough, believe me, there were a lot of mainstream investors who watched the gold market go up from 1999 to 2010, 2011, and they didn't buy any gold. And then when gold got to the highs, that's when they bought. And then they all panicked and got out when it started to go down. Those are the people who screwed up. But the people who understood this from the beginning, we didn't buy all our gold at the highs. We had a huge position by the time gold got to the highs. And even if we added a little bit, we still had a very, very good average price. And now we've averaged down a little bit more, in the last few years. But I think even the people who were dumb enough to only buy their gold at the top, right? Let's assume you never heard of Peter Schiff, and the first time you heard about me was when gold was over 1,800, and for some reason you decided to put all your money in right then, which was not my advice, but let's say you did that. I still think you're going to be better off in a few years, or maybe even in 1 year, we'll see, than the people who don't own any gold. Because the people who don't own any gold at all, those are the ones that are going to be broke.
Well, and I do want to point out, Deutsche Bank settled a fraud case. I mean, the criminal case. I mean, so this was not good-natured manipulation, Peter. I mean, they were fraudulently rigging the gold and silver markets. I just wanted to get that on the record. But I do want to talk about the coming crash. I mean, you're talking about people like, Jim Rogers, who says this is going to be the biggest bear market ever that's coming up. Do you foresee a big crash in securities, equities, at least here in the U.S.? Do you see a big crash coming?
No, look, not if the Fed does what I think it's going to do. If the Fed comes out with both barrels blazing of money printing, then it's not going to happen. But if I'm wrong and the Fed does not rescue the markets, well, then Jim Rogers is going to be right. I mean, if you look at what's already happening in the European banks, look at these banks being obliterated. I mean, these things are dropping to a much greater degree than they did in the 2008 financial crisis. And obviously, if the European banks are blowing up, I mean, they're all interconnected. I mean, the U.S. banks can't be that far behind. And these banks are also hitting 52-week lows. They're not below their financial crisis lows, but they might be going there. And I think they will go there without some help from the Fed. But I do believe the Fed is going to come in. They're just trying to time it. They're trying to figure out how to do it in a way to save face, to lose as little credibility as possible. And they're also looking at the election, whether they want to do it before the election or after the election. They're worried if they have to rescue the markets before the election, that it might damage Hillary Clinton's credibility if the Fed is seen as trying to save the markets. But then again, if they don't do anything and they let everything implode, well, that might hurt Clinton's chances even more. So they're trying to thread this political needle. They're trying to salvage their own credibility. But the last thing they want is the markets to implode. Somebody asked Janet Yellen at this latest Humphrey Hawkins testimony, if the Fed, about the Fed and the markets. And Yellen lied and basically said, we don't care about the markets. We're just going to set our monetary policy regardless of the markets. I mean, that's just a bold-faced lie. They care about the markets. That was the very reason they did QE in the first place. They wanted to prop up the markets, not only the stock market, but the housing market, the bond market. This is one gigantic asset bubble. And the last thing that Yellen wants it to do is deflate.
Actually, they're on records calling it the wealth effect. Remember that they wanted the wealth effect. They wanted it to go up. So
even if it's phony wealth, right? It doesn't matter that the wealth isn't real. They just wanted us to think we were wealthy. So we would act like we were wealthy, even though we weren't.
And finally, last question. I know you're a big Republican up there in Connecticut, and are you supporting Donald Trump?
Well, I support Donald Trump over Hillary Clinton. So if it came down to a choice between those two, I would choose Trump. And one of the reasons I would support Trump is I'm certain that Hillary is going to be a disaster. I don't know about Trump. He could surprise me. He could also be a disaster, but he could be a great president. I don't know. I mean, it's very unknown. A lot of the things he says I disagree with, but I don't know if he actually means what he says or he's just saying what he thinks is good politics. There are some things that he says that I absolutely agree with. So I don't know. Obviously, the candidate that is closest to me ideologically is Gary Johnson, and he is the Libertarian candidate. And this should be a great year for the Libertarian, with so many people dissatisfied with both Hillary Clinton and Donald Trump. You've got something like 50% of Bernie Sanders supporters who say they don't want to vote for Hillary. And you've got all these Republicans who are saying we need a third party. No, we don't. We've got a third party. It's the Libertarian Party. They've been here for a long time. They're going to have a candidate on the ballot in all 50 states. In fact, both of their candidates for president and vice president were former Republican governors. And so if Republicans want a third party, they've got one. They've got two of their own ex-governors on a ticket that's in every state. So I don't know why they wouldn't get behind them. The media is still not really giving enough coverage. They talk about how everybody wants a third party. Okay, well, here he is. And if Gary Johnson could just get into those presidential debates, then we might have an interesting election. But, they're going to try to keep him out of the debates. In order to get into the debates, you've got to be at 15% of the polls. But the problem is Gary Johnson's not in the polls. So first you got to get into the polls so you can get at 15%. But if the media actually decided to give Gary Johnson the kind of coverage that they gave Donald Trump, he'd be in the polls and he'd be in the debates. And who knows, he might even be in the White House.
Yeah, well, I don't think either party wants that. And I hear that Gary Johnson hurts Hillary Clinton more than he does Donald Trump. So we shall see. But listen, Peter Schiff, thanks for coming on and giving us your update on the markets, on Brexit, on what you think is going to happen in the next 6 months to the end of the year. Really appreciate it. One last thing, gold. What do you think gold is going to be January or December 31st, 2016? What do you think gold and silver prices?
I'm not smart enough to know where it's going to be, but I'm smart enough to know that it's probably going to be higher than it is today. And so from that respect, you should just buy it. And either you'll be pleasantly surprised by how much higher it is, or maybe just mildly. But there's no way to know for sure. But the sky's the limit to how high gold can go, because there's no limit to how low fiat currencies can fall, because they can fall to nothing. And if your currency becomes worthless, the price of gold becomes infinite, expressed in that currency.
Peter Schiff, Euro Pacific Capital, also Schiff Gold. Peter Schiff, thanks for joining us today on USAWatchdog.com.